Hi, good afternoon, good morning, depending on where you're listening to us from today. Welcome to another great educational webinar we have for you here today at Advanta IRA. Today's topic is going to be how to create cash flow with non-performing notes. And we have a great guest speaker who's going to join us in a few minutes to go over really what a non-performing note is and really how to get it performing or creating cash flow from that particular investment. Really looking forward to the speaker that we have joining us today. I'm your host. My name is Scott Maurer. I'm the Vice President of Sales for Advanta IRA. I'm a licensed attorney. I've been with Advanta IRA since early 2006. I don't do any legal work for Advanta clients, but I've seen a number of different investments over the years, and non-performing notes to me has always been one of the really interesting ones that people have done inside of their retirement account, taking an asset or an investment most people probably would think never to touch in a million years, but actually turning it into something that's profitable inside of a retirement account, or maybe not inside of a retirement account, depending on how you're investing. Now, if you have any questions, if you're listening to the live presentation today, there's a question box in the GoToWebinar control panel. Please type your question into that box. We'll make sure that we get to it during the presentation. If you do want to take your question offline and you have a question about self-directed IRAs, my contact information is here on this slide. Feel free to email, give me a call. Happy to answer your questions as it relates to IRAs. Just a quick disclaimer, at Advanta IRA, we do not provide investment advice. We don't endorse any particular products. The information materials that we provide, the webinars that we do, are for educational purposes only. If you do need tax, legal, investment advice, we may consult with your own attorneys, your accountants, your advisors. If you need a referral for one, we have people who are professionals who are familiar with self-directed IRAs that we could certainly refer you over to. Just a little bit about Advanta IRA. We're a nationwide self-directed IRA administrator, really specializing in two areas, I think, for our clients. One is on the personal side. We give every client a dedicated account manager, so they'll have one point of contact in our office for anything that they need regarding their account, not only helping them with their investments, but any questions they may have on their IRA. And we also do a lot of education. Our Learning Center, today's webinar, is yet another extension of what we do in trying to provide people with great information on different types of investments, different investing options, different strategies, etc. We do one or two live webinars a week. We have a live networking session once per month. We call Pitch, Promote, and Prosper. It's usually one of the last Fridays of the month at the noon hour Eastern time. And we do record all the webinars. So if you're listening to this webinar live today, you'll have the ability to go back and listen to the recording, to re-listen to some of the things that we said today. If you're listening to the recorded version, great. And if you have questions for myself or our guest, reach out to us after the recording. But we do record all of our live webinars, and the links to those webinars are placed on our YouTube channel. Now, very quickly, I want to talk a little bit about self-directed IRAs before we get into our presenter today. Most people have not heard about self-directed IRAs, primarily because they have IRAs, they have old 401ks that are held with banks, they're held with brokerage houses who only offer you the investments that they sell. The IRS regulations allow you to do so much more within your retirement account, so many different choices, so many different assets, but a lot of people are limited to those publicly traded assets because that's where their funds reside. They have monies in Schwab or Fidelity. They're not going to offer the ability to invest in real estate, self-storage, or non-performing notes like we're going to talk about today. So you do have other choices. That's what our company exists to do, is to allow you to invest in those assets that you understand and that you can control. As far as what accounts can be self-directed, any type of IRA. So if you're listening to the presentation, you want to know, hey, are my accounts going to qualify for these types of investments we're talking about today? If your account is an IRA, if you look at your account statement and it is any type of IRA, whether it's a traditional or a Roth IRA, whether you're self-employed and you have a SEP or a simple IRA, you could absolutely use any portion of those funds that you wish to self-direct. Also, if you have a former employer's plan, like an old 401k, an old 403b plan, an old 457 plan, maybe you work for the federal government, you have an old TSP, as long as you are no longer working for that employer, you can roll that money over into a self-directed IRA account. And the best thing about the IRAs and the old 401ks is that you can transfer or roll over just the amount you want to use for the particular self-directed investment. Self-direction is not an either-or strategy as opposed to when you talk about brokerage assets. You can have a brokerage IRA and you can have a self-directed IRA, and you can transfer and move money between accounts so that you can take advantage of the different investment options that are out there. Now, some of the investments that you would see within a self-directed account it is very real estate heavy, and the presentation today is going to be going along with that theme. People invest in rentals, they invest in rehab properties, where they invest short-term rentals where you're investing in maybe one specific property that you're looking to buy. Other people invest into multifamily syndications or retail centers where you're investing into a very large project and you're holding maybe a small piece of the pie. Private lending, which we're going to, again, dive into today. Mortgages, deeds of trust, unsecured notes, and as we're going to talk about today, non-performing notes as well. So your IRA can invest in a lot of different things. Again, the assets on this screen are primarily real estate in nature or real estate related. We see people invest in gold, silver, private startup companies, hedge funds, a lot of different things you can do as well within your particular account. Now, in the area of private lending, if you're looking to initiate a new loan from your IRA, one of the neat things to me is that you can kind of choose how you're going to structure that note. We have people who do traditional mortgages, short-term transactional loans. They structure their note as a joint venture opportunity. They may secure the note with different types of assets, not always real estate. And we even have people who do unsecured lending through promissory notes, maybe a little bit riskier type of an investment, but it is allowable under IRS guidelines. And one of the, again, interesting things to me when it comes to private lending is, again, the terms that are involved. You get to act and sit in that position as the bank. If someone's looking to borrow money from you, you can determine exactly how much you're willing to lend, what the interest rate's going to be, when when repayment will happen, and it can be a much more low maintenance asset. Maybe when we talk about non-performing notes, there might be some more work you do there, but for some of the initial private loans, if you're initiating a loan, you just want to make sure you get paid back every month. Get your monthly mortgage payment, monthly loan payment back in. You're not actually having to manage the real estate itself, and therefore it can also be have a little bit less liability if you're just holding the note on a property or investing as a limited partner as opposed to buying the property just directly in the name of the IRA. Now, if you want to learn more about private lending in an IRA, we do a presentation we call Be the Bank with your IRA. You can definitely find a recording to that on our YouTube page or look for the next upcoming live webinar that we have. But at this time, I want to bring in our guest presenter who's going to talk about investing in non-performing notes. Her name is Paige Panzarello. She's been a real estate investor and entrepreneur for over 28 years. She's featured as a guest on a lot of podcasts. We've had Paige here. It's been a few years since she's been on with us. We've had her on as well to really talk about what it is that she does with, again, buying non-performing notes and other types of cash flowing assets, which is why her nickname is the Cashflow Chick. Paige, how are you doing today?
Hi, Scott. Thank you so much for having me on. I really appreciate it. It has been a minute since I've been on.
Yes.
And first, before anything, I want to make sure you can see my screen. Yes?
Yeah, I can see your slides just fine. They're coming up perfectly. So yeah, it looks good. I'll let you get rolling. Again, if anyone has questions for Paige, for myself during the presentation, please type those questions into the question box on your screen, and we'll make sure that we get them answered. But Paige, I'm going to let you take it from here.
Great. My goodness, thank you again for having me on. As Scott said, I am known as the Cashflow Chick. My name is Paige Panzarello, and I've been in real estate for a really long time as an investor. I've done just about everything there is to do in real estate investing, with the exception of becoming a realtor, and I'm actually in the process of making that happen as well. So, and when I got into real estate investing, I did so kind of by accident. I did not choose real estate. Real estate chose me, and by virtue of inheritance. My grandmother passed away. She had a very large estate, half of which was in Arizona, all of which was severely in debt. We were about $4 million in debt, and I went to Arizona to try and salvage what I could of those assets. We had 38 townhome units. We had some land that was undeveloped, and we also owned a sewer treatment plant. Yes, I owned a sewer treatment plant, and that's a pretty stinky business. But anyway, I was able to kind of go into this real estate investing space with a fresh, clean slate. I knew nothing, so I had to ask a bunch of questions, especially because the properties were so severely in debt. I was forced to connect with people, and real estate really is about people. It's about teams and people. You cannot do this alone. So it forced me to ask a lot of questions, and I surrounded myself with people that had the answers to the questions I was seeking. Fast forward about 18 months, I was able to, the townhome units, by the way, were really broken. There were some units that were untenable, they were not livable, and we were only about 40% occupied. Within 18 months, I was able to rehab all of those units, put great tenants in there, and we were at 100% occupancy. I worked with all the people to whom we owed money, and within another 6 months after that period, I was able to get us back into the black. So that was fantastic, and I learned a ton. But I realized, because we were in a fairly boutique market, that I was not going to be able to sustain profitability for very long in the townhome units. So we sold each individual townhome unit, and I parlayed that money into developing the land. And I hired a contractor, and I very quickly realized that the contractor was going to bankrupt me before we started going vertical, meaning before we started coming out of the land. So I fired him, and I started my own construction company. And I knew nothing about construction, but again, I surrounded myself with the people that had the answers to the questions I needed to ask. I brought in a qualifying party to qualify for our construction licenses, and we held all of our construction licenses, commercial, residential, everything except HVAC and roofing. And the only reason we didn't go after those is because the insurance was just way too high. Within a 3-year period of time, I had 36 employees. We were running projects, our own projects and everybody else's project locally in the area and the outskirts as well. Our crews were running, I was running 5 big projects at any given time, and we were running payroll at about $25,000 per week per project. So if you know anything about construction, that is a very big bill to foot, because when you are doing other people's projects, you're footing the bill for about 90 days so their lender can pay you. So we had, even though we weren't encumbered, I wasn't encumbered by a tremendous amount. On my own projects, I probably only had about 10% worth of debt that was being carried by investors and lenders. But other people, other projects owed a tremendous amount of money to me. And I'll tell you, I was very successful at a very young age, but it also took a toll. I was working at least 18 hours a day, 7 days a week. I was in Arizona, my family was in California, my friends were in California. So I was literally, even though I was young and healthy, I was starting to become ill. The stress alone was killing me. And this is all leading up to 2008 and 2007, 2008. I saw the crash coming, and I thought, this is not going to happen to me because I'm only 10% encumbered. Well, I was wrong. Unfortunately, because everybody else's lending froze up, that bill that I was carrying for 90 to 120 days was not being paid back. So I had a decision to make when the crash fully happened. I could either file for bankruptcy, like many people did, and walk away, or I could sell all of my assets at rock bottom prices, because in those days cash was king. And I chose to sell all my assets and then pay off everybody I owed money to, and that's the route I chose to go. I was very fortunate because I did have cash flowing assets. I had other investments, I had large equipment, and I was able to sell all of that off and pay everybody back the money that I owed them. Unfortunately, that did not happen with me and the people that owed me money and my company money. And so after the crash happened, I walked out of Arizona having lost $20 million. Now, I don't mean to be cavalier about that. It's a tremendous amount of money, but it did teach me things, and it taught me how I relate to people and to money. It taught me my risk tolerances. It taught me who I am as an investor. And because of that, my investment strategies going forward have mirrored those risk tolerances, which I'm very, very risk averse at this point, as you can imagine, having lost that amount of money. So when I went away from real estate for a little while, I had to regroup and kind of lick my wounds a little bit. But when I came back in, I started doing some of the same things that I was very familiar with, fixing and flipping, wholesaling, all those fun things. But I heard about this thing called notes, and we're going to talk about notes today. And I was very intrigued because I wanted something that cash flowed and created chunks of cash as well in the same investment vehicle, and it allowed me the control of that asset. So I came back in heavily to non-performing notes. I started JVing with people because, of course, at that point my capital I needed to increase my capital. And I was able to parlay that into a fund. And the fund has been very successful in investing in non-performing notes. We actually focus primarily on non-performing notes, but we're also very bullish on self-storage. So we're going to talk about that a lot today. So as I said, our primary investment strategies are non-performing notes, self-storage facilities, and using the combination of the two to acquire properties. Most people don't know that you can use non-performing notes to actually acquire property. So we're going to talk about that strategy a little bit today. Okay, briefly on self-storage facilities, because self-storage facilities are fairly self-explanatory. Americans do not get rid of their stuff. They just don't. We like to hold on to our things. It's funny to me that most Americans will even go to yard sales and they'll buy stuff and they'll put it in storage. So we're very, very bullish on self-storage facilities as regular properties. We love the cash flow that comes from self-storage. They also, if you buy them in the correct areas, and we like to focus a lot on tertiary markets because they're outside of big cities, but there's still growth and development happening, which creates high equity returns for us. This is also a depreciating asset. So as opposed to notes are not depreciating assets unless you take possession of the property, and we'll talk about that a little bit later as well. So in order to balance the fund and be able to offer ourselves and investors some depreciation, we needed something that we could focus on that fits our buy box and not having to lease up or maintain tenants per se in the traditional sense, but have that same cash flow and potential for equity returns. Typically, self-storage facilities have very low taxes, property taxes, because they are considered warehouse buildings, right? So they're not taxed as heavily on property taxes as perhaps a multifamily investment or something along those lines. And also, a lot of states are very tenant friendly in apartment and home rentals, and in most self-storage facilities, each state is a little different, but typically in self-storage, they're very landlord friendly. If a tenant does not pay their rent, then you overlock their unit, and the process to get them out is fairly quick, as opposed to some states where your rental, you might be for years with that person squatting in your home and not paying rent. Believe me, I've been there, done that, and I don't want to do that again. So that's why we focus a lot on self-storage. Also, clean out is a breeze. I mean, literally a breeze. Clean out of a self-storage unit, we need a leaf blower. That's about it. We don't need to replace carpet. We don't need to paint walls. We don't need to replace toilets or any of those things. So that's another just bonus. Often the facilities, like I said, we look for facilities in tertiary markets, just the outskirts, and a lot of these are mom and pop owned facilities, and they are severely mismanaged. Most often, they also sit on a lot of land, so there's room to expand by adding units, thereby creating additional possible equity returns. Sellers in that situation oftentimes also, especially because of increasing valuations, typically will agree to owner finance. And this allows the fund to take, to have that owner finance over a period of time at a lower interest rate, and there's less money out of pocket for us. It also creates, the reduction of gains, capital gains for them. Because again, a lot of these mom and pop facilities they've run them for the last 20 to 25 years, and they've increased in value in their basis substantially. Nowadays, and this is not the case 10 years ago, but nowadays technology allows for many processes to be automated. So units can be rented directly online, and there's not always a need to have a manager that is physically on site, though many of self-storage facilities still maintain that on-site manager. And then again, management can be outsourced to a specialized third party of managers, right? They integrate the tracking technology as part of their service, and it really creates a less hands-on situation for you as an investor. So we are really, really excited and have been focused. If we're going to be buying properties, they're going to be self-storage facilities. So again, a lot of these are underperforming, and we are able to stabilize, increase rents to current market rents, because oftentimes they are not at current market rents. We stabilize occupancy with our paying tenants, and thereby nearly create about 100% economic occupancy at each facility, which is fantastic. We do CapEx updates as needed, or we expand the storage facility footprint by adding units, and then implementing the technology for ease of flow for both the tenants and the management. Okay, so that's pretty self-explanatory. We're not going to talk a lot more about self-storage. If you have questions, please let me know. I did want to talk about the wonderful world of non-performing notes. And I'm sure that that's primarily why you are here today as well. It is definitely, like Scott said, it's good to be the bank, and you do step into the shoes of becoming the bank. So let's talk a little bit about what are notes. Notes are basically just a promise to pay. There's a lot that goes into evaluation of a note, and we'll briefly talk about that a little bit later, but notes are just basically a promise to pay. And there are, whoops, wrong, I keep going the wrong way, sorry everybody. I often get the question, do you really become the bank? Yes, you become the bank. Now, I'm not saying you become an FDIC insured federal depository with a brick and mortar building, but you step into the shoes of the bank, and as the bank, you maintain a tremendous amount of control. As Scott said earlier, if you do become the bank, you are able, especially if you're originating the note, you can set the terms and conditions of that repayment of the note, okay, of that promise to pay. So if you step into the shoes of a note that's already been originated, you are beholden, at least initially, to the original terms of that promissory note and it is typically secured by something. Scott mentioned before that you can go into unsecured notes. Because I'm so risk averse, I do not like unsecured anything. So the different types of notes that you can buy are unsecured versus secured. You can buy performing versus non-performing. That's fairly self-explanatory. You can buy first position liens, second position liens, HELOCs. There are so many different types of notes that you can buy, judgments, there's factoring notes, there's all kinds of different notes that you can buy. I tend to focus on first position, non-performing notes secured by real estate. I initially started out in residential real estate, but I ventured into commercial, some land notes as well. And then, of course, we'll talk about how to parlay into even multifamily notes, office space, and or self-storage, okay? So there are different notes types that you can buy. I focus on non-performing first position notes that are secured by real estate, okay? Whether that be land or a building. So why on earth would I buy a non-performing note? As a note investor, as in any kind of investor, you want money coming in. So if you buy a non-performing note, that means that the borrower has stopped performing. They have stopped paying their mortgage. The reason that I like non-performing notes is because I buy these notes at a deep discount based on the current market value of the securing collateral, or whichever is less, or the unpaid principal balance of the loan, okay? And the example I'm going to show you in a moment, I'm going to show you about a loan that is underwater. Recently, we have had loans that are not underwater because we have an overinflated valuation of properties. And even though these mortgage holders, the borrowers are not paying, they still have equity. So there is a little trick. There's still a way to make money with that non-performing note that has equity. However, you have to know how to negotiate the sale with the seller, meaning the bank, okay? So, but I buy at a discount of the lesser of the unpaid principal balance or the current market value of the securing collateral. Is there competition in note investing? Yes, like anything else, there is competition in note investing. However, I call it the gentler form of real estate investing. There's much less competition in that you just develop relationships with the asset managers. They send you the list, it's called a tape. They send you the tape of the assets they have for sale, and then you are making your bids based on the numbers. Most people don't know that you can invest in notes, and so the competition is less. We also don't have, I don't do any marketing at all. I build relationships with asset managers that have assets for sale, and then I perform. This is a very reputation-based industry. They are non-emotional about these assets, unlike most home sellers that are perhaps in foreclosure. Those people are emotionally attached to their home, and the fight to get them to actually understand that they're going to lose their home can sometimes be brutal. Or they list it with a realtor, and we have crazy pricing and crazy bidding wars where people are paying over $100,000 over list. There is none of that in the note space. Okay, so yes, there is competition, but it is gentler and fairly minimal. It's more of a team sport. One of the other things is you can do this business anywhere in the world. I can literally be on a beach somewhere. As long as I have an internet connection and a cell phone, I can be anywhere in the world and do this business. I am not tied to one specific location, okay?
Yep. Paige, we had a question just come in, and it might be something you're going to get to. Just wanted to, so you
Yes.
said talking exit strategies. This is what the kind of question is about. So it might be a little premature, but
Yeah.
someone's question said that they and their partner recently foreclosed on a property where the buyer non-performed. So they just foreclosed and took the property back, and said the property though was worth much less than what they lent on the particular property. Is there any options on how to recoup their initial investment other than selling the property at a deep discount? So they can't afford to be patient. So I don't know if that sets up what you're going to talk about now, but that was one of the questions that came in from a viewer.
That is a key. What you just said is really key. They can't afford to be patient. The short answer is yes, there are ways, but you have to be able to be patient. The beauty of notes is that there's over 23 different exit strategies, and you need to be able to pivot. What I would suggest, and again, not knowing your situation, perhaps try and sell that. Well, I was going to say try and sell it to a fix and flipper. If it's a damaged property, try and sell it to a fix and flipper, and perhaps take an equity piece on the back end.
Okay, that's a good strategy. Yeah, like I said, I'll keep the questions coming. Those people who are listening, and we'll make sure. Yeah, we'll let you get back to the presentation.
Yeah, no, and really quickly, I should have articulated. Please, you would carry the paper on that asset for the fix and flipper, but you can recoup some of the problem with the deficit by taking an equity piece on the back end as part of your terms to carry the paper. So I hope that helps. Okay. So let's talk some exit strategies. And again, this is going to be a very general, very simple explanation of the numbers. Okay, it's not usually this minimal, but let's talk about that. All right. So unpaid principal balance, that's the principal amount of the loan. That means that and sometimes there are extras. So the principal balance of the loan that is still outstanding is $100,000. The legal collectible balance includes fees that are paid on behalf of the borrower by the lender. In other words, property taxes. We can pay as the lender if the property taxes have not been paid, which is very likely since these notes are non-performing. Those are recoverable expenses. And then default interest. There are many things that are recoverable as the lender, as the bank. So let's say in this instance, the legal collectible balance is $120,000, and much like this previous question, the property is worth way less, right? So the property itself is only worth $80,000. You're owed $120,000, but it's only worth $80,000. So this borrower is $40,000 in the hole. All right. I'm going to buy this note based on the $80,000, not the $120,000 and not the $100,000, because this note is underwater. Now, for round numbers and easy math, I'm going to say 50%. When I started buying notes I was buying at about 36 to 38 cents on the dollar. That is not the case anymore. Note pricing has gone up substantially. Now, I do expect it to come down. It has been a little harder in the last couple of years to be buying notes, at more reasonable terms. They are out there, but you've got to really look. But I do suspect that, especially because we're on the brink of about 300 banks failing, I do suspect that pricing is going to continue to come down. It's been slowly ebbing down. But for this example, we're going to say 50%. So note purchase price, 50% of the current market value, which is $40,000. We also have workout costs. Now, workout costs may not be as expensive as you think. Non-judicial foreclosure states hover around $5,500 a year. Judicial foreclosure states hover around $8,500 to $10,000 a year. It depends on the state, and I don't have time to go over that in detail, but they're a lot less expensive. So your all-in for this note is $45,000. Now, again, you have built-in equity because remember, the current market value of this property is $80,000, less your all-in, so you're sitting at purchase in equity of $35,000. In terms of exit strategies, we use 4 main exit strategies. However, we do have 23 plus at our disposal. Foreclosure is my least favorite. It is, everybody knows what a foreclosure is. It typically, depending upon judicial versus non-judicial state, will take anywhere between 6 months, sometimes a little less, depending upon the stage that the note is in. Sometimes this foreclosure has already been started. So anywhere from let's call it 4 months, 4 months to 18 months or longer, depending upon the state. For instance, New York is going to take you 48 months to get through to foreclosure. So don't buy in New York. I don't buy in New York for that reason. Okay, there's some great assets in New York, but I don't want my money sitting around for 4 years. So be very specific about what time frame you're looking to invest in. Okay. Short sale, everybody knows what a short sale is. That same $120,000, you can agree to sell that property or allow your borrower to sell that property at $80,000 if you would like, and then short the sale. They are no longer on the hook for the 120 that they owe you. Okay, now if that happens, obviously, and as if they sell the property, the time frame is much smaller, right? It usually only takes about 90 days, priced right, to sell a property. So in 90 days, your $45,000 is going to return you that $35,000. Now, again, you're probably going to have to short a little bit more because I don't think that the borrower is going to be able to pay the realtor commission. So that's probably going to be on you as the bank, taking a shorter payoff. But again, you get the idea. Deed in lieu of foreclosure, that is when the borrower agrees to sign over the deed of the house to you in lieu of going through a foreclosure proceeding, so they don't have a ding of foreclosure on their credit. This is a great exit strategy if you want to take possession of the property. And oftentimes, if they're sitting on equity, that might be the way to go. You might also need to pay that borrower some cash for keys in return for the deed in lieu of foreclosure. Now, you want to make sure that you don't have any secondary liens behind you, any junior liens behind you, because once you take possession of that property, your loan goes away and anybody that's behind you becomes your headache. Okay, you will need to be responsible to pay that second or the HELOC or whatever it is. So make sure that in your due diligence, if you're going to take a deed in lieu of foreclosure, that you're going to check title and make sure that there are no junior liens behind you that you're not going to be willing to pay or able to pay. All right. Reperforming loans. Reperforming loans are my favorite exit strategy, especially when working with residential, because I get to work with the borrower to keep them in their home. In the example with the $120,000 that's owed, just because the current market value of the property is $80,000, that doesn't mean I have to reduce the loan amount to $80,000. What if we incentivized our borrower to reduce on a trial payment plan that gets converted to a permanent loan modification? We'll incentivize them. If you pay the first 3 or 6 months and you do well, we'll convert this loan to a permanent loan modification, and we will wipe out $20,000 worth of arrearage that is due. So we will reset and refi that loan that's owed $120,000 at $100,000. We can defer principal, we can reduce interest rates, we can lower the principal balance but increase the interest rate. Most people don't realize you can do that. To make, it depends on your short or long-term play, and I don't have time, unfortunately, to discuss that, but if you want to, please reach out to me and I can explain that strategy to you on a private call. All right, but those are my favorite, is reperforming, because we're creating chunks of cash, and I'm going to show you that in a moment, and streams of monthly cash flow, and we're resetting the loan. When you refi a loan, even internally, as we all know, the bulk of the principal and interest payment goes to interest. And that is where you make a lot of your profit as a note investor, is through interest, okay? So it's a great investment strategy. It's a great exit strategy. It works really well between you and your borrower, and you don't necessarily have to take possession of the property, even though you are secured by the property, okay? How important is due diligence? I always like to throw a funny in there, right? When something doesn't look right, pay attention to that, okay? Due diligence is extremely important, and don't ignore the signs that everything looks great, but there's one thing that might be a potential problem. Always dig deeper, okay? Because good due diligence will give you virtually risk-free note investing. I like to say there's no such thing as a bad note, but there is such a thing as buying notes badly, okay? So pay attention. Due diligence in note investing is very heavy up front. You're going to spend the bulk of your time as a note investor when you're evaluating that note. Once you buy the note, you hand it off to your external team. We have third-party servicers and loss mitigation teams that handle borrower contact, and they handle the servicing of the note. They collect the payments, they disperse the payments to you as the note investor. They keep track of all of the conversations. They keep you legally compliant. So even if you are going to carry the paper and become the bank for someone else, please use a servicing company. Because if there's ever a discrepancy between the two of you, a servicing company is a licensed debt collector, and they keep articulate records. And it's very difficult to challenge a foreclosure if you're using a servicing company, okay? So please do that. All right, so case studies, and I'm running out of time, so I'm going to go quickly through these as best I can. I like to start out with the worst case study. And I want you to know this is because anybody, let me say this, anybody that tells you if they've been in real estate and they tell you they have not lost money in real estate, one of two things is happening. Number one, they're too new and they haven't been in real estate long enough. Number two, they're lying to you, because everybody who is experienced in real estate and real estate investing at some point has lost money. Okay, so vet your sponsors, vet them. This is your hard-earned dollars, and you need to be very, very secure with whom you invest. All right. So I like to start out with the worst case study. And all of these, by the way, I have to throw out the disclaimer. These are all case studies from my portfolio. Okay. I cannot guarantee that the outcomes will be the same for you. I have done literally hundreds and hundreds and hundreds and hundreds of notes. And I have lost money on notes, usually because of a time frame, not because I've missed in terms of my expectation of the borrower or evaluation of and due diligence on that note. Okay, usually it's because of extended time frames. This case study is an extreme case, and in all of my years in note investing, I've never seen anything like this before or since. This note is in Cleveland, Ohio, and this borrower, this was his family home. He grew up in this home, okay? And he had been squatting there. This note I bought, and my purchase price was $18,867. The workout cost that I had allocated for this note, this is back when it did not take 18 months plus in Ohio to foreclose. Ohio is a judicial foreclosure state. My workout costs, I allocated $6,500. I acquired this note in April of 2017. Owner occupied forever. The legal collectible balance, that's what LCB stands for. Legal collectible balance was $83,074. The original interest rate was 7 and change, okay? The house was only worth $55,000. The borrower played every single game in the book. It extended our time frame, it extended our legal costs, and I ended up ultimately all in for this note at $65,000 and change. Okay, it's far cry from the initial $25,000 I had allocated. We offered loan modifications, cash for keys, settlements. Nothing worked. We had to foreclose on this loan. He evaded service. Then when he was served, he asked for mediation. We had to go to court. Then he agreed to a deed in lieu of foreclosure and some cash for keys. And then we went through that whole process, got the legal papers done. Then he backed out. We finally got the foreclosure through in late 2019, and the borrower had not moved. We had to go back to court to evict him. The eviction process took well over a year. Now, keep in mind, we are just starting into COVID times. Thankfully, we started the eviction pre-COVID because we might still be there. After the eviction, we finally got the eviction through. The judgment was granted. The borrower had to get approval for we had to get approval from the sheriff to lock out the borrower. That process takes 45 to 60 days to coordinate. The day of lockout, now this is the law in Ohio. We were forced to have a moving company on site at the lockout day with a crew of minimum of 4 guys. They charge $125 an hour each per guy. So, and we have to pay for that. We must have a realtor and a locksmith on site at the same time the sheriff shows up in order to proceed with the lockout. If anyone was late, then the lockout needs to be rescheduled, another 45 to 60 days. We had everybody there, everybody was on time. We started and the borrower had packed literally nothing. So we had to pay the movers to pack everything for him, which took 12 hours. The cherry on top of this crap Sunday, our borrower left all the stuff, including trash, that he didn't want to have moved or throw away. So we had to pay for a storage unit, there's storage unit for 30 days because it's against the law to throw anything away that the borrower left in the house. Now, he had lived in this house rent-free, mortgage-free since 2013. Now, this house was great on the inside. It was only worth $55,000. We were trying to sell the house at $55,000. We were going to end up taking a loss, but the neighborhood, even though the house was great inside, the neighborhood was terrible outside. We finally got it under contract to sell it to a wholesaler for $40,000, and he was in the middle of a couple of deals, so it was gonna. We agreed to a 60-day escrow. All right, we were going to take the $15,000 loss, but because there had been a pipe that broke or leaked or something, and water had been running for at least a month. We think it was probably more like 45 days, and now we had destruction. All right, we had mold. That is the same house. Thankfully, we had forced place insurance, and the policy, we helped maintain that policy all the way through owning the house, right? The insurance ended up paying us $60,000 in the insurance claim, okay? Then we sold the house to that same wholesaler on top of the $60,000 insurance claim. We sold it to him for $13,500 net. We didn't have to pay any of the closing costs or property taxes or anything. So we grossed $73,500. We ended up in an $8,500 profit, but it took us a ton of time. It could have been a lot worse. But because we did good due diligence, because we followed the steps, because we put forced place insurance and paid attention and exercised all of the opportunities afforded to us as a lender, we were able to turn this into at least some semblance of a profit, okay? This one, and I'm going fast, everybody, I'm so sorry because I'm running out of time. This one was a Victorian where the owner had passed away. The current market value of that property was $125,000, but the after repair value, if you're a fix and flipper, showed $225,000. Now, all in for this note was $54,200. The borrower was deceased. They did not want to do a deed in lieu of foreclosure. The area was in process of gentrification, but it had been a bit rough. Across the street was a brand new rehab, brand new. It was in process. This property was also zoned R3. Pay attention to zoning, because we could have torn this property down and built an apartment complex, okay, or apartment building. And there were next door and down the street some multifamily apartments. Squatters had done some minor damage. So again, see, back to, you can acquire property through non-performing notes for a substantial discount. I just ask, if you do that, try and focus on vacant notes so you're not kicking families out of their home, because that's not fun. All right. All right, squatters had done some minor damage. We took this property to foreclosure auction. We were owed $217,000. However, remember I told you the current market value was only $125,000, so I wanted to create a bidding war. So we set the opening bid. We as the bank get to do that. We set the opening bid at $116,000 and change. There was a bidding war. We sold this at foreclosure auction for a little over $124,000. Our net profit was $70,000, or approximately 129% return on transaction. I call it return on transaction because ROI implies 12 months. This did not take 12 months. This took less. This was in Virginia. It's a non-judicial foreclosure state. So I think this note probably took us eight months, give or take. All right, so 129%. Our JV partner at that time realized a 65% profit as well. Now, I kept up with this property because I'm a former rehabber, and I wanted to see what they did. Sure enough, they rehabbed it and they sold this house for $230,000 90 days after they bought it from us at foreclosure auction. Okay, now imagine if you wanted to do this yourself.
Hey, Paige, I had a question on that, because one of the questions somebody else raised was how much cash, it says how much capital do I need to have? So I guess talking in general about buying non-performing notes, I guess that's really going to depend upon your exit strategy, right? Because if the last case study, you would have needed about 55K or so, it looked like, to get in, and that was your all-in cost.
Yes.
But if your exit strategy was, I'm going to buy the non-performing note and then rehab it, then you need to have those costs as well as part of your capital.
Correct. So, and you have to buy the note and then take possession of the note. Now in this case study, because we were owed $217,000, if I wanted to rehab this house myself, I as the bank could set the opening bid at $217,000, thereby forcing nobody's going to buy it if it's only worth $125,000. Thereby forcing that foreclosure auction to end with me taking back the property, okay? So I can force up to the dollar amount that we're owed and then I could have rehabbed it myself and turned around and sold it for $230,000. I didn't have to start the bid at 116. I didn't want to rehab it, okay? Now, to answer the question, there are notes that are out there. They're in higher risk areas, but there are notes that are out there that you can buy for $10,000. Understand that it's a higher risk area, and you're probably going to need the workout costs if you're going to do this yourself. Or you can invest with somebody that does this and have your money working for you, which is, part of it. And that's a lot of why I started the fund, is that I had a lot of students that wanted to do this, but they didn't have the money necessarily. They had their money, they didn't have the money to buy a more secure note, less risky note, but they wanted to take advantage of the medium to do so. So it was a natural progression for me to start a fund. So, so people that don't necessarily have a huge amount of money to go buy a bunch of higher end notes, you can buy notes for a lower cost. They're just going to be a little riskier, and you have to be willing to take that risk. I've bought notes as recently as just a couple of years ago that were $3,000 to $5,000, but I knew there was huge risk in doing so. You have to be willing to lose that money, right?
Okay, yep. Thanks for the answer. And yeah, well, I guess you have another case that you get there. We'll wrap things up in a few minutes.
I do, really, and I'll do it really quick, just because this one focuses on my favorite exit strategy, if that's okay.
No problem.
Okay, so this one is in Richmond, Kentucky. The last paid to date on this one was 4/19 of 2012. These people literally were squatting in their own home for 6 years, waiting for somebody to foreclose on them or help them. All right. So I bought this note. Our all-in was 49,000 and change. We acquired it late 2018. It was owner occupied since 1998. Good due diligence showed me that I had a feeling that these people wanted to stay, which means I was going to be able to exercise my favorite exit strategy, which is reperform, okay, and get them into a loan modification. They owed a legal collectible balance of 95,000. Their interest rate was really high at 10.99, okay? The reason they went into delinquency is the husband had a medical condition. He couldn't work for 3 years. We used our third-party loss mitigation team and contacted the borrowers. They said, of course, they wanted to stay in the home. In March of 2019, we were able to put a trial payment plan in place for 6 months. Now, in a trial payment plan, you have not already permanently modified the loan, which means it's free money. So any monies that you earn goes to the old loan balance in a trial payment plan. So I call that free money because you're very likely going to, if they're successful, modify the loan and turn it into a brand new loan, okay? So the trial payment plan, I often require our borrowers, as nice as they may be, I require them to put a little skin in the game. So they paid a $1,000 reinstatement fee. So there's your chunk of cash. They paid for the first 6 months a trial payment plan. Their payments were $708 a month. And the reason for that is that we had to pay a success fee to our loss mitigation team. So ultimately their payment ends up being $608 a month, but for the first 6 months during the trial, it was $708, so we could pay the loss mitigation success fee. All right, so we ended up with $4,200 and change in cash flow for 6 months. That did not apply to the new loan. That applied to the old loan. The TPP was converted to a permanent loan modification as of October 1st. We ended up rolling a lot of the arrearage into the new UPB, and then we discounted the UPB slightly to $87,500. So that's the new principal balance of the loan. We reduced the interest rate to 8% from 10.99, and we extended the loan to 40 years instead of 30 years because it made the payment more manageable for the borrower, okay? So you add all that together, and the first year we ended up with, I'm sorry, I got ahead of myself, $1,000 deposit, $4,200, $48 in the trial payment plan, plus $608 a month in monthly cash flow. The interest that is showing per month for the first 60 months is approximately $580. That's interest of the $608 monthly payment. That's pure profit, everybody. Times 3.5 years that we held this note, that interest payment alone was $23,780. The borrower gets to keep their house. We created a win-win situation. Okay, they were ecstatic, we were ecstatic. We ended up selling this note in February of 2023. So let's add all that up. Sold the note for $82,500, which was a slight discount off the UPB of $86,000. That's where the borrower had paid it down over the course of 3.5 years. They only paid $1,500 to principal. That's why I said it's good to be the bank and refi the loan, right? They barely touched the principal. It was all interest. The net on the note sale was about $34,850. So you add all of this together, and we ended up with $63,878 as a net profit, which is approximately 130% return on transaction, which gave us an average ROI over each year of 28.8%. I've done this all day long. Here's some other screenshots of other examples of notes. where we average triple-digit returns. Now, am I promising you that? No, because there are some notes that we only get a 6% return. Some notes we only get a 25% return, right? So but it's a very lucrative investment strategy if you know how to do it. If you don't know how to do it, then invest with somebody who does know how to do it, and ride their shirt tail, right? Ride their coattails. Okay, free stuff. If you want some free stuff, please go to cashflowchick.com/free. It's cashflowchick.com/free. If you have more questions, book a call. I would love to get to know you. I would love to answer your questions. If you scan that QR code, it will take you directly to my calendar. So you can book a call with me for free, of course. If you don't want to scan the QR code, that's fine. Go to askcashflowchick.com, and that will also take you to my calendar. Or you can email me. Of course, you know me by Cashflow Chick. My company name is the Trillion Group. So Paige at Trillion Group or Paige at Cashflow Chick. You can follow me on Facebook, YouTube, LinkedIn, Twitter, Instagram. Instagram is at the Cashflow Chick. And I would love to hear from you.
Yeah, Paige, thanks again for the great presentation. Like I said, I've always found non-performing notes so interesting because I think a lot of people, like you said, may just think like, oh, those people aren't paying. Well, I don't want anything to do with that asset whatsoever. That's a loser. But obviously being able to see the other side of it in a way to capitalize, and obviously the different exit strategies as well is always so interesting to me. So I really appreciate you coming on and sharing that today.
Absolutely. Absolutely. Thank you for having me, Scott. I always love to speak to people and open some eyes about non-performing notes because it does sound very counterintuitive.
Yep. Yeah, and we did have one other question that popped in. I wanted to make sure I got to here. We have a couple minutes, maybe we run a little bit over, but someone asked, much more towards the beginning, they said they have, her and her husband have 10 rentals, some short-term and mid-term rentals, but it's becoming much of a hassle, and we're kind of considering an exit strategy for that. But self-storage, they said, seems like a viable option.
Yeah.
Just curious if you have any advice on either finding a distressed property or buying land and building kind of a new self-storage. Do you kind of prefer one option over the other, finding kind of an existing one that you can take over and rehab and get the cash flow from that self-storage facility, or perhaps just, like I said, someone saying buying land and buying a new one?
Yeah, so, like anything in construction, you need to be able to wait out the delays. So, if you buy the land, and I'm certainly not opposed to that, just because of my background, and we do that, but you have to be willing to wait. It's probably going to take you about 8 or 9 months, depending upon the county and depending upon the zoning, to kind of get it up and get your first building up. Depends on how many buildings you want to build as well. And then you've got to go through the marketing and advertising to lease it up. So if you have that kind of timeline, and it takes about 24 months to really get a storage facility from start to finish off the ground and leased up to a place where it's profitable and cash flow. All right. If you buy a self-storage facility, and again, I've been there, done that with the headache of tenants and toilets. I don't ever want to do that again. I can tell you some horror stories that would make your skin crawl. I like the type of tenants that we can overlock and then get them out within a 45 to 60 day period of time, and use a leaf blower to blow, to get that unit ready for the next tenant. So looking for storage facilities in tertiary markets, you have to be willing to drive for storage, like go to your area. I live in California. I can tell you self-storage facilities in California are very expensive. So I don't even look in the big cities. I don't typically like to look in California, though I do have my eye on a couple of very small markets that are way out, that have been run by mom and pop. So, but I know I'm going to have to pay a higher price. So if you want your capital to be working for you more quickly, I suggest that you go to, buy something that's already been leased up and probably poorly managed, where you might only have a 30% vacancy rate and market rate, they haven't raised rents in 3 years. Believe it or not, there are storage facilities that are out there that are like that. Or again, if you want to convert your rentals and roll them somehow, some way, and again, Scott, you're the better person to know how to do that into your IRA. I am not, so I defer to you. But you can just use it as a passive investment strategy and invest in somebody's fund that invests in self-storage and shares the equity with you on the back end, because everybody's fund is different. Vet your sponsors, everybody, vet them.
All right, thanks, Paige. One last question and we'll let you go. Someone said, how will becoming a real estate agent be a benefit to you? So I don't know, that's something we really talked about today, but do you think there's a benefit in some of the things that you do where someone would becoming a real estate agent be a benefit to you?
Yes.
In your investing?
Yes, and actually, because of my experience, I've been approved to go for my broker's license, and I'm doing that for a couple of reasons. Number one, as a note investor, I have taken properties back as an REO, and I will employ a realtor in the local area to sell that asset. And I realized over the course of my 28 years just how much money I have left on the table in just referral fees alone. So that was one of the reasons that I wanted to do that. Is that I wanted to be able to collect a referral fee on an asset that I'm not going to be selling. So that was one of my strategies. The other is I do have access to the MLS in a couple of areas. I would like, and I also have kind of a national broad strokes access, but I do think that the access will give me a leg up in some of the markets that I'm looking in, to be able to access that MLS and use that to my advantage in due diligence.
All right, well, Paige, again, thank you very much for coming on today. Someone did ask, how do we do that? You said mentioning the self-storage using the IRA side. That's just a very, very straightforward solution. It's a matter, as Paige said, you can open up an IRA account, you can roll over or transfer money from an existing retirement account. And then what we do at Advanta IRA is actually help you then with the investment paperwork. So if you're investing into, say, a self-storage fund, there's going to be subscription paperwork that needs to be completed in the name of your IRA account. We work with you to make sure that gets done properly, make sure you review and approve the documents, and ultimately make the investment. So it's definitely something happy to take offline as well and talk in more detail about it. But it is very easy to, when you're talking about self-directing your IRA, some of the strategies you've heard today, especially investing into fund, are very, very simple processes. You just need a company like ours to help walk you through it and do that. So
yeah,
again, Paige,
and it's very passive, which is fantastic.
Yeah, absolutely. That's what IRAs are made for, right? Passive and income.
Yes, exactly. So, when a lot of people try and self-manage, a lot of their properties, and it becomes exhausting. It becomes a full-time job. So, especially working with you and Advanta, it really takes that headache and that stress off, but you get all of the benefit of the experience of the sponsor, and you don't have to do it yourself. It's great.
Yep. All right. Again, well, Paige, again, thank you for coming on, sharing your wealth of knowledge today. Again, very, very great topic, and I'm sure everybody got a lot out of it, as we could see with some of the questions that came in. So thank you again for coming. Thank you all for attending and listening to the presentation today. The recording will be up on our YouTube page probably later today or tomorrow. So make sure to look for that. Again, Paige, thank you very much for your time today.